Welcome to Griffonomics.
Always a pleasure to be here.
I am thrilled to have you joining us today. If you're tuning in, you already know the drill.
You're looking for a rigorous, unfiltered shortcut to being genuinely well-informed.
Exactly. Stripping away the market noise to find the actual structural signals. Today, our focus is a granular investigative report into Geron Corporation.
Traded under the ticker GERN.
Right, GERN. Our objective is to dissect the company's fundamental transformation.
Because they are currently attempting to cross what is arguably the most treacherous chasm in biotech.
Transitioning from a cash-burning clinical stage R&D firm into a disciplined, profitable commercial entity.
Which is never easy.
No, it's not. We are zeroing in on what we're calling their restructuring and Rytelo inflection point.
And to build this analysis for you, we aren't just skimming press releases.
No, we've pulled together Geron's 2025 Form 10-K, their recent 8-K filings, the full transcripts from their Q4 earnings call.
Plus their latest corporate presentations, and a stack of intensely polarized Wall Street analyst reports.
Joining me to help synthesize this data and pressure test the investment thesis is our resident expert.
Yeah, thanks. Geron presents a really fascinating case study. What we're looking at is the exact moment when complex, decades-in-the-making science collides with the unforgiving realities of commercial market dynamics.
It's a harsh collision.
It really is. It is one thing to prove a drug works in a controlled clinical trial. It is an entirely different beast to convince thousands of independent oncologists to change their prescribing habits.
Okay, let's unpack this. We have to start with a foundational asset. Geron's entire valuation, and frankly their immediate survival, rests on a single commercialized product.
Rytelo.
Right, generically known as imetelstat. The FDA approved this in June 2024, specifically for lower-risk myelodysplastic syndromes.
LRMDS.
Yes, LRMDS, in adult patients suffering from transfusion-dependent anemia.
And we should establish exactly why this approval garnered so much attention in the oncology space. Rytelo is a first-in-class telomerase inhibitor.
The specific terminology in the filings describes it as a lipid-conjugated 13-mer oligonucleotide.
Which is quite a mouthful of chemistry.
Yeah, I mean, instead of dusting off standard textbook analogies, let's talk about why that specific molecular structure matters commercially.
Absolutely. So previous generations of researchers have tried to target telomerase. That's the enzyme that malignant cells use to infinitely rebuild their chromosome caps.
Like the little plastic aglets at the end of your shoelaces.
Exactly like that. It allows them to multiply out of control, but those prior attempts largely failed.
They were either far too toxic to the patient or they just couldn't successfully penetrate the target cells.
Right. And that is where the lipid-conjugated part of the description becomes the crucial differentiator.
By attaching a lipid, essentially a fat molecule, to the active oligonucleotide, Geron basically gave the drug a cellular passport.
It allows the therapeutic to seamlessly cross the lipid bilayer of the cell membrane. It specifically targets and penetrates those malignant stem and progenitor cells in the bone marrow.
It binds directly to the RNA template of the telomerase enzyme.
And just shuts down the abnormal cell's ability to replicate.
And the clinical result of that mechanism is what separates Rytelo from legacy treatments.
Standard of care options for this condition, like erythropoiesis-stimulating agents or ESAs, are fundamentally just palliative.
They boost red blood cell production to temporarily manage the anemia. They don't actually fight the disease.
But Rytelo is demonstrating actual disease modification. It is actively depleting the malignant clones.
In their IMerge trial, nearly 40% of patients achieved 8-week transfusion independence,
Compared to just 15% on the placebo.
What's fascinating here is the stark disconnect between that undeniable clinical efficacy and the company's recent commercial reality.
Right, because if you just read the trial data, you would assume revenue is climbing exponentially.
But by late 2025, the commercial momentum had effectively flatlined. Q4 2025 net product revenue came in at $48 million.
That was a miss against analyst expectations.
And more concerning, it was essentially flat year over year compared to the $47.5 million they posted in Q4 2024.
But wait, looking at the underlying metrics, patient demand for Rytelo actually grew 9% quarter over quarter.
They also grew their ordering accounts by 13%, adding roughly 150 accounts to bring the total to around 1,300.
So walk me through the math there. How do you grow your prescriber base and patient demand by those margins, but post-flat revenue?
It seems contradictory until you look at the volume per account and, crucially, the line of therapy. This brings us to what the analyst reports are calling the salvage trap.
Ah, yes, the salvage trap.
According to the National Comprehensive Cancer Network, the NCCN, their official guidelines position Rytelo as a Category 1 preferred second-line treatment.
That means right after a patient fails their initial ESA therapy, they should ideally be moving straight to Rytelo.
However, real-world data shows that oncologists are largely utilizing it as a third-line or salvage therapy.
They are cycling patients through older familiar treatments like lenalidomide or hypomethylating agents first,
Reserving Rytelo only for when those patients are significantly sicker and completely out of other options.
which means those 1,300 accounts are likely just prescribing it once or twice for their most desperate cases.
Rather than making it a standard part of their early treatment protocol.
For you listening, this dynamic is the absolute crux of the Geron investment thesis.
Having stellar trial data and official NCCN guideline endorsements doesn't automatically overrate decades of ingrained physician behavior.
Doctors are just comfortable with the side effect profiles of older drugs.
Geron's entire path forward in 2026 relies on breaking out of that salvage trap and capturing a meaningful share of the approximately 8,000 eligible second-line LRMDS patients in the U.S.
Here's where it gets really interesting.
Because when a launch stalls like this, management can't just cross their fingers and hope doctors change their minds. You have to force a pivot.
And new CEO Harout Semerjian, who took the helm in August 2025, pulled a rather drastic lever.
In December 2025, Geron initiated a massive strategic restructuring.
They laid off 33% of their entire workforce.
They cut roughly a third of their 260-person headcount just weeks before the end of the year.
It is a severe maneuver, resulting in a one-time $17 million restructuring charge in the fourth quarter.
Primarily for severance and benefits.
But from a capital preservation standpoint, Semerjian deemed it necessary. The underlying strategy shift here is critical.
Geron is explicitly abandoning the traditional, highly expensive biotech playbook of building a massive boots-on-the-ground sales force.
Right, they're shifting to what management has branded a 3D surround sound marketing strategy.
Which, yes, sounds like they are trying to sell you a home theater system.
It does, but beneath the corporate jargon, it represents a fundamental shift in capital allocation.
It means replacing expensive door-knocking sales reps with targeted digital engagement.
Non-personal promotion and deep integrations with third-party educational platforms.
And there's a structural reason for this. The data shows that approximately 80% of MDS patients are treated in decentralized, high-volume community clinics.
Not at a handful of major academic research hospitals.
Sending reps to blanket thousands of disparate community clinics is a logistical nightmare.
So, by utilizing data analytics to identify those specific high-volume community prescribers,
They are hoping to surround them with peer-to-peer data and digital education.
efficiently forcing that behavioral shift from third-line to second-line usage.
If we connect this to the bigger picture, this digital pivot is also a forced response to the margin compression the company endured throughout fiscal year 2025.
Let's get into the financials, because the gross-to-net margin squeeze is a glaring issue in the 10K.
Geron posted $183.6 million in net product revenue for the full year 2025.
But the gross-to-net, or GTN, deductions, the rebates, chargebacks, and mandatory discounts required to actually move the product are climbing fast.
In 2024, GTN was 14.5%.
By the end of 2025, it had risen to 17.7%.
And management's forward guidance offers no relief there. They project GTN deductions to climb into the high teens to low 20s for 2026.
This headwind is directly tied to their push into those community clinics we just discussed. A significant driver of this margin compression is the wider utilization of 340B hospital pricing.
We should briefly clarify that mechanism for context.
The 340B program requires pharmaceutical companies to provide steep mandatory discounts to certain qualifying healthcare organizations that treat vulnerable or low-income populations.
Precisely. As Geron pushes deeper into the community oncology setting to expand their prescriber base,
They inadvertently expose a larger percentage of their sales to these mandatory 340B discounts,
add to that the expanded contracting power of group purchasing organizations, or GPOs.
which aggregate buying power to demand heavier rebates just to keep Rytelo on the clinic's formulary.
The net result is that Geron has to surrender an increasingly larger slice of their gross revenue just to maintain their current prescription volume.
Margin compression and a stalled launch usually spell disaster for the balance sheet.
But looking at the liquidity, Geron actually ended 2025 with $401.1 million in cash, cash equivalents, restricted cash, and marketable securities.
That is a formidable war chest for a company of this size.
It is, but we have to look at how that war chest was constructed. It is heavily levered.
That liquidity is underpinned by a $250 million loan facility from Pharmakon,
Of which they have already drawn down $125 million.
Furthermore, they secured another $125 million through a synthetic royalty agreement with Royalty Pharma,
Which entitles Royalty Pharma to tiered future percentages of Rytelo's U.S. sales.
They have essentially mortgaged their future commercial upside to ensure they survive the present.
And the dilution risk remains a major factor. In February 2026, alongside their earnings report, Geron filed a new $150 million at-the-market, or ATM, sales agreement.
Management brushed this off on the call as routine corporate housekeeping.
But when you factor in that Geron carries an accumulated deficit of $1.9 billion since its inception.
Yeah, that is a staggering number.
It really is. That ATM signals to the market that the company stands ready to issue equity and dilute current shareholders if the cash burn accelerates.
So what does this all mean?
We have a scientifically validated asset caught in a line of therapy trap.
We have a company executing a painful restructuring to pivot their sales strategy.
Facing rising discount pressures, but armed with enough debt-backed cash to fund the turnaround, what are the catalysts that break them out of this holding pattern?
We have to look at the roadmap, beginning with Europe.
Rytelo secured approval from the European Commission in March 2025.
In theory, opening the EU market should be a major revenue driver. However, the European healthcare landscape is notoriously fragmented.
Navigating the Health Technology Assessment, or HTA, pricing negotiations like the AMOA process in Germany or the HACHAS in France requires immense localized resources.
Geron has rightly concluded they cannot fund that launch alone. They are actively seeking like-minded partners to take over the commercialization in Europe.
Which protects their balance sheet, but also means any European revenue will be shared.
And likely delayed until a favorable partnership is finalized.
But the true binary event for Geron, the catalyst that overshadows everything else we've discussed today, lies in their clinical pipeline.
Specifically, the Phase 3 IMpactMF trial.
This trial is evaluating Rytelo in patients with relapsed or refractory myelofibrosis, which is a different, highly aggressive blood cancer.
What makes this trial critical is its primary endpoint, overall survival, or OS.
In the oncology space, demonstrating an OS benefit is the ultimate gold standard.
But it is incredibly difficult to achieve in blood cancers because patients often cross over to other salvage therapies, which muddies the survival data.
Because it is an OS endpoint, the trial is event-driven. They must wait for a predetermined number of patient survival events to occur before analyzing the data.
And that brings us to the timeline. There is a critical, event-driven interim analysis scheduled for the second half of 2026.
If the data is statistically overwhelming and the trial is halted early due to clear success, it completely transforms Geron's valuation overnight.
It proves the drug works across multiple severe indications.
But if it fails to cross that high statistical bar at the interim, the final analysis gets pushed out to 2028.
In the biotech market, asking investors to wait 2 more years for data is a heavy lift.
This raises an important question regarding the environment management is operating in. We cannot look at this turnaround strategy without acknowledging the legal pressure they are facing simultaneously.
Yes, and before we detail that, I want to be explicitly clear to you listening. As analysts, we strictly impartially report the facts as they are stated in the source documents.
We do not take sides.
We are not endorsing the viewpoints of the plaintiffs in these lawsuits, nor are we validating the company's defense.
We are simply conveying the claims contained in the public filings to provide a complete picture of the company's risk profile.
That is exactly right. The objective reality is that in early 2025, a series of putative securities, class action, and shareholder derivative lawsuits were filed against Geron.
The core allegations from the plaintiffs state that Geron made materially false and misleading statements to the market regarding Rytelo's commercial trajectory
And its overall market potential.
To reiterate, these remain allegations. But from a structural analysis standpoint, defending these suits drains financial resources and executive focus.
Precisely at the moment when management needs to be entirely dedicated to executing their digital marketing pivot and navigating the 2026 catalysts.
Bringing this all together, we look at the final verdict on Geron as a turnaround play.
Unsurprisingly, Wall Street is thoroughly fractured. You have institutional analysts rating this stock anywhere from a firm sell to a speculative buy.
The bull thesis, the buy case, is built on valuation and operating leverage.
Bulls point out that Geron currently trades at an enterprise value-to-sales ratio of roughly 3.15.
Which is quite attractive relative to biotech peers with commercial-stage, first-in-class oncology assets.
Furthermore, the bulls argue that Semerjian has already ripped the Band-Aid off. The 33% headcount reduction resets the baseline.
This creates a classic setup for 2026 where the company can underpromise and overdeliver.
And you can see the path to break even in their guidance. Management is projecting 2026 net product revenue between $220 million and $240 million.
Thanks to the restructuring, they've capped expected operating expenses tightly between $230 million and $240 million.
If the 3D surround sound strategy yields even moderate success in shifting doctors to second-line prescribing,
Geron hits those numbers and achieves operational break-even without having to tap that $150 million ATM facility.
However, the bear case is equally substantive. Bears argue that physician prescribing habits are notoriously stubborn.
If this new digital marketing pivot fails to alter real-world behavior and Rytelo remains confined to the third-line salvage setting, revenue growth will stall out permanently.
Couple that with the rising 340B margin squeeze and the potential for European payers to reject Geron's pricing expectations.
And that theoretical path to break even rapidly disintegrates.
It is a high-wire act. The science is proven, but the commercial execution is on trial.
Before we wrap up this deep dive, I want to leave you with a final provocative thought regarding the science that we haven't touched on yet, but that could fundamentally alter this entire narrative.
Right now, Geron is supporting over 10 independent investigator-sponsored trials, with data readouts expected in the second half of 2026.
They are attempting to prove a radical hypothesis regarding Rytelo's safety profile. The primary adverse events associated with the drug are cytopenias.
Dangerously low blood cell counts.
In standard oncology practice, severe cytopenia is a deterrent. It is exactly why doctors hesitate and relegate the drug to a third-line salvage option.
But Geron's researchers are trying to prove that this specific side effect is actually an on-target indicator of clinical response.
The hypothesis is that because Rytelo is systematically hunting and killing the malignant clones in the bone marrow,
the resulting drop in blood counts is actual biological proof that the drug is successfully clearing out the cancer.
If the 2026 trial data definitively proves that the side effect is actually a prerequisite signal of efficacy, it completely flips the script.
It provides oncologists with the clinical rationale to aggressively manage the cytopenias rather than fear them.
Completely validating earlier second-line use. It is a brilliant scientific gamble that could single-handedly solve their commercial bottleneck.
It's going to be a fascinating year to watch them execute this.
And that is the full structural picture of Geron's inflection point. Thank you for joining us as we navigate the intersection of clinical science and commercial reality.
See you on the next deep dive.
Risk defined, portfolio protected.